Welcome to Rappaport Connects, where we interview notable Rappaport Foundation alumni and fellows. I'm Sean Horrigan. Today we're joined by 2024 Rappaport Institute Public Finance Fellow and a current Rappaport Institute Fellow in Mass Housing, Samya Mishra. Samya is the author of the Rappaport Institute Policy Brief, Capital Funding for Affordable Housing, launching the Momentum Fund in Massachusetts. The fund is the first in the nation state revolving fund to support mixed income housing production created under the Affordable Homes Act. Samya Mishra, welcome to Rappaport Connects.
Thank you. Thank you, Sean.
Samya, let's start with you providing us with an assessment of the state of affordable housing in Massachusetts. And also let us know what qualifies as affordable housing in Massachusetts in a state where housing is so expensive.
Sean, affordable housing has been a problem in not only Massachusetts, but the rest of the US. What we've typically seen over the last 5 to 10 years, and a little over that as well, is that rental prices have significantly outpaced the growth in incomes, the median incomes. So average rental prices, let's say from 2019 to 2024 across the US, have grown at about 4.9% annually, whereas median incomes have just grown at about 0.1%. So that itself tells you a lot about the demand and supply mismatch. And to further add to that, in Massachusetts, we've seen that for the last 4 decades, there has been a steady decline in the number of permits that have been getting approved for housing. To further amplify this problem, ever since the pandemic started, we've seen that the average interest rates have risen. The cost of construction has risen with a higher cost of materials as well as labor. With both of these points put together, many projects stalled, many projects did not get approved. And as a result, we had a huge backlog of permits and stuck projects that led to furthering the gap between the demand and the supply of affordable housing in the state of Massachusetts. As per a study by the Unlocking Housing Production Committee, there is an estimated 220,000 units of housing needed by 2035 to meet the unmet demand of housing for the state of Massachusetts. Now, what qualifies as affordable housing? We consider a unit to be affordable when the average rent for that unit is within 30% of the income of the resident. And the income of the resident should be capped up to 80% of the area median income for that location. So if you are at 80% AMI or below, you could be at 60% too. The rental of the accommodation that you're living in should be within 30% of your annual income amount. So that's what qualifies as affordable housing, and that's the mission that the state is on, to increase more and more affordable housing units from a production standpoint and reduce the demand-supply gap.
Thank you for sharing that. Samya, I read your policy brief and watched your presentation hosted by the Rappaport Institute, and you highlight a program launched by the Healey Driscoll administration known as the Momentum Fund, which uses public equity as a financing tool. Tell us about the Momentum Fund and how it compares to grants and loans.
Sure, Sean. So the Healey Driscoll administration actually approved a $5.2 billion Affordable Homes Act in the mid of 2024. That was precisely for the reason of accelerating production across the state. Of that amount, about $50 million has been set aside and authorized to issue the Momentum Fund, which has been a novel tool that the state has designed and is executing for the first time to take equity participation in deals. Now, the government of Massachusetts and most state as well as national governments globally have usually taken grants, subsidies, tax incentives, as well as debt as the standard mechanisms, financial mechanisms to spur development growth across projects, right? These could be large infrastructure deals, and housing in particular has never really seen significant equity participation in the past. Because in equity, you're essentially taking construction risk or you're taking revenue stabilization risk. So that amount of risk public dollars have usually not taken in the past. So here in this particular product, the state government, the public dollars are going to be infused during the early construction and stabilization phase to partake in the risk of the development itself, and not simply go with tax credits or subsidies and debt as a form of investment. Also, equity takes equal participation in risk without burdening the developer with constant and steady repayments, as is the case with loans. and is also cheaper than a lot of debt that is available in the market, especially with the product that we launched. So we took more risk than a standard loan at almost the similar or lesser price as a regular debt. So that was the unique point of taking this kind of a equity product and launching it in the market. And it allows more flexibility of repayment to the borrower or the sponsor of the project.
Fantastic. You analyzed the fund's strategy of offering lower, more affordable return rates to developers. What factors help you determine what an appropriate return range should be?
So we extensively benchmarked both private sector funds as well as public funds, which invest in real estate markets, to arrive at the ideal benchmark IRR for our product. So if you see in the policy paper too, we benchmark funds which could go with returns of 18 to 35%. And then we looked at funds that were in the 9 to 12% range. And they had a mix of outcomes and incentives packed into the theory or the impact guidelines of that fund. And then we had investors or impact funds which were also operating in the 5 to 8% IRR range. So we wanted to keep a blended return range that is able to allow us to stretch our dollars back and incentivize a higher rate of return to private sector investors in future, because we want this fund to not only be reliant on public dollars for investment, but to also attract co-investment from private sector players. So we basically steadied the rate of return at the US 10-year treasury rate plus 150 to 200 basis points. Now, what that allows us is that since our cost of borrowing is so low as a quasi-public agency, we are able to play with the returns that we seek at 6% or 4.5%, and take that back in order to allow private sector investors to take, let's say, up to 8.5% returns, so that the blended result is still at about 6.5% for the borrower. So we maintain the capped cost of capital for the borrower in the deal.
Great. Thank you for that explanation. Your brief explains that momentum equity can replace costly developer equity, covering cost overruns or refinance loans. Based on your evaluation, which of these seem most likely to remove barriers for stalled projects?
So, Sean, most of the real estate projects face a very high initial time period lag where the sponsor or the borrower or the developer basically is spending a lot of time not only getting permits and approvals, but also shopping for equity investors. So whether it is LPs or additional GP capital, that's the period which takes, it's very time consuming, and also has a lot of fluctuations in the kind of rates or cost of the capital that the sponsor will be typically incurring. So with this momentum equity product, we aim to also reduce that time to market, right? When you have a commitment from a government to put in a certain amount of dollars as equity investment, you are typically able to procure private investment faster as well. So I think the cost of capital or getting private equity investment faster is one of the priorities. Second is we want to, of course, absorb any cost overruns, as I mentioned during the COVID period and post that for the last 3-4 years. Cost overruns, both financing costs and construction costs, have been predominant. And the aim of this money is to sort of come in and absorb some of that cost overrun and allow the projects to still continue and complete.
The program saw strong developer interest very early on, with 33 proposals in just 1 month. What did this surge tell you about the gaps or challenges developers are facing today in today's housing market?
So, Sean, I think it pretty much emphasized that the theory we had about the stuck projects and the need for commitment early on was pretty much validated with the vast application pipeline that we saw. 33 projects of totaling about $4 billion of capital requirement. And most of these projects were very vastly varied in their stage of readiness. So some were in the design stages, some were already permitted, shovel ready, and some had already begun construction and had already incurred a lot of pre-development costs and needed some sort of public commitment to come in and ease that cost that has already been incurred. So it showed that developers needed the money. Some needed it today, some needed it 1.5, 2 years from now, but the interest was already a lot. And we saw that we need to perhaps continue and revolve this kind of capital for future growth as well.
Samya, you worked with the readiness versus spend efficiency matrix to evaluate the projects. What patterns or trends stood out to you among the highest scoring or most promising proposals?
So we divided all of these projects because they were very vastly different in terms of their locations or the stage of readiness that they were in. So we had to divide them in peer groups. We had to see what location and what AMI levels did each of these projects typically fit in. Some are in gateway cities, some are in transit-oriented development areas, so they're closer to the T or expressways and things like that. So we had to come up with a lens that divides all of these projects into peer groups and then finally divides them as per a selection matrix. And the best matrix that fitted the bill was those that were, first of all, pretty much ready. We're shovel ready to start the construction and produce our units sooner because that's priority for us. And second is, where are the government dollars leading to the most efficient leverage in terms of the number of units we're able to produce? So that is spend efficiency that we typically talk of. So how many units per dollar are we able to get in project A versus project B? So that was one of the criteria. Of course, the first and foremost criteria is that the financials have to be very robust as well, because we have a fiduciary responsibility on the financial outcomes from each of these investments. But beyond that, we had to, of course, look at some of these factors to see when can we have the production of units delivered the fastest.
Gotcha. Thank you. One of the first projects to receive financing is in East Milton. Your analysis shows how the fund improves the project's financial outlook. Why was this project chosen and what made it attractive? And from a researcher's perspective, how do you think policymakers should gauge whether investments like this offer a good public return?
That's a great question. And East Milton deal was one of the first deals that we announced from this program. And out of the 33 projects, we had basically shortlisted about 7 to 10 projects that made sense for investments in the first phase or phase one. And the East Milton deal turned out to be one of the favorites. I would say ranked the first out of the first 5 that we want to invest in. What made this attractive was that this was a project that had incurred a lot of pre-development costs already. So it was pretty much in its, late stage of readiness. It was already pretty much shovel ready. It had commitments from Fidelity Investments and other private sector investors as well. It had all the permits in place and just wanted a little more financial infusion to get it off the ground and execute it. And out of 92 units that were expected to be built, 23 were going to be affordable. So that was also a good ratio in terms of the units we're getting from the first deal itself. Also, I would say that if the momentum equity hadn't come in the cap stack, we saw significant additionality for our public dollars. It was like a but for our investment. It wouldn't have been, successful because without the public equity coming in, the fund would have typically incurred carrying costs of about $3.1 million. With our money coming in, the return of the overall fund improved to about 7.09%. And that improved the overall cash and cash returns, as well as the equity multiple for the project. So there was a strong additionality cause for our dollars coming in. It was also a transit-oriented development. It was close to speeding expressway and had good connectivity. And there was also a redevelopment angle here. So there were certain vacant units on the site which were going to be demolished, and then these new units were going to be put up. So all in all, from an impact policy as well as additionality standpoint of government dollars, this seemed like a good deal to start with.
Samya, your report notes upcoming state and city co-investments, which would significantly expand the fund's reach. Based on your research, where do you see the greatest need or opportunity for the fund to focus as it grows?
I think the fund would want to now focus on not only increasing affordable units, but also looking at other impact themes within these developments. So while this is the first phase of applications, we had developers sending us, some were very detailed performers, some had very solid impact story, but some were very basic as well. Over time, the ambition and the outlook for these kind of programs from a public policy standpoint should be to train and also incentivize developers to include a lot of, let's say, energy efficiency, social impact themes, transit-oriented development, so that they think more within affordability and a public policy view built into these developments rather than very simple basic cap stack and basic return philosophies. So that's the way we would want this fund to eventually motivate the developments from the design stage itself and have that incorporated by the time they reach the stage of application for accessing these funds. And for that particular purpose, we're also in the process of redefining and redesigning the asset management and asset investment reporting framework, which will be co-managed with other co-investors and sort of published as an impact report in future as the fund grows.
Thank you for sharing. I know you were a 2024 Rappaport Public Finance Fellow. Tell us about your experience as a fellow and what you took away from that.
I think I had, out of my 12 years of work experience, I had worked predominantly in financial services or private sector consulting and private sector industries, and only about 3 to 4 years in, public sector topics. So when I worked right after graduating with mass housing with the Rappaport Fellowship, I felt I was working in an organization that had impact policy as an objective, but still had the innovation DNA that is seen in private sector firms. So I enjoyed that. I really like the fact that we were innovating at the speed, the scale that we need to. We were executing deals, but with a lot more impact as the central focus, and doing it for themes that are important for the public today. So as you've heard, right, food, clothing, and shelter are the three most important needs of humanity. So while in the private sector, we might want to go to the space, or we might want to do other missions to reach the moon, etc. It's the public sector and entities like this and workforce like ours that work to make living very dignified for people who are still on this earth. So with that, I was very happy and very satisfied with the kind of work I did, putting all my investment, policy, and all hats together to a cause that really felt good, and I believe in it.
Fantastic. Well, we're proud to call you a Rappaport Fellow, and it'll be very exciting to watch the Momentum Fund grow and see how it expands. And I would encourage everyone to read Samya's policy brief, which I will attach a link to here. It's well worth your time. And Samya, thank you so much for joining us today. This was very enlightening and very innovative and exciting approaches to the housing crisis. So thank you for sharing them with us.
Thank you very much, Sean. And yeah, delighted to have been a part of this journey with Rappaport. Thank you.
Thank you.